So we completed booking the entire year 2020, different modes, but we did book the entire year and it reconciled. So we have our books ready to go to prepare the taxes, right? Let's go ahead and run some reports and prepare information for Schedule C, which we will use to file taxes for this operations. It's a single member LLC, and thus it is a disregarded entity for federal tax returns. Here we are, good to go. All right, so what reports are we going to run? Profit and loss, right? We got to know that one. And again, profit and loss covers information for a period of time. So in this case, from January 1st, 2020 to December 31st, 2020. Here it is, right? Our sales, $128,450.98. Not bad for the first year. Expenses, $54,655.14. Not bad. All right, and we so far have net profit of $73,795.84. Right here, the button says accrual. We can do cash, and it will not change because at this point, you know, we booked everything within the same fiscal period, so we don't have anything outstanding to the future periods, and therefore this amount will not be affected by this. But in the future, we'll cover the difference between these two. Anyway, this is our profit and loss for the period so far. Let's run one more report. And in this instance, balance sheet. Let's take a look at that one. Balance sheet gives us a reading at a point in time, right? So we're going to run it as of December. Okay, and that shows our position. There's a couple of accounts that we're going to close using year-end adjusting journal entries that your accountant would give you, or you could do it yourself, and that's the member draw and the net income. We will close those both into the equity, right? So far we have assets, some equipment we have, right, that we purchased. We have balance on hand, some cash, and in our bank account. We also have a liability, right, with the credit card. And altogether, you know, our equity is at $1,406.46. So we're highly leveraged if you think about it. But anyway, you know, it is what it is. So let's go ahead and continue. What's going to happen? So let's do our adjusting journal entries, and you'll see how the balance sheet will change and the income statement will change to, again, to bring it to where we will be close to filing essentially using Schedule C. One thing is that we have equipment right here, right? And we can write it off using Section 179. So the entire amount will become depreciation expense. I mean, the equipment will still be there, but there'll be accumulated depreciation that will bring that equipment to essentially zero for tax purposes, and the entire amount will go into depreciation expense. So let's book that one, right? One thing at a time. So it's going to be our adjusting journal entries. Okay. All right, so our depreciation expense will go up by the entire amount. Let's see, what is the amount? 4105.31. And our accumulated depreciation will go up as well, right? But in this case, accumulated depreciation is an asset account, so it's credited. Will reduce the overall assets. I know it's kind of like with the member draw, right? Because accumulated depreciation, technically, in the class with the assets, credits reduce it, but that's fine, right? Because what it does, fundamentally, it reduces our assets. Increases our expenses, reduces our assets, right? So again, we can reflect it here. Okay, here we are, and you'll see it after we book it. So save and close. Okay, see it's updated, right? So accumulated depreciation right here, it reduces the assets. So our fixed assets right now it's zero, right? But at the same time, if you look here, right, our expenses went up because see, we now have depreciation expense added, and therefore our net income went down. Okay, so again, our net income got reduced. Let's take a look at our balance sheet. As you can see, our total equity got reduced as well because our net income is lower now, and now we have a negative equity. Makes sense, right? Because we owe more money than we have assets. And for tax purposes, that's fine. Again, even though that asset's still probably worth quite a bit, and from standpoint of GAAP, if we were preparing it, we wouldn't write it off like that, right? We would still have depreciation substantially less than the asset, but for tax purposes, we're going to take it down to 0, and therefore, again, even though we're not going to be filing the balance sheet with IRS or other tax authorities, technically for tax purposes, our equity is negative in this instance. So one more thing, we can do is we can close out the draw into our equity account. So again, so that next year it's showing up correctly. So again, it would be an adjusting journal entry. So here we are. Again, what's happening is we're just moving it from account 30,700 to 32,000, right? Just to close it out. Alright, and you can see that it's now in the equity, and then again, if we run it, the QuickBooks will close the net income into the equity as well. So if we run it for next year, you see all we have is member equity, and then we can start tracking the draw again for that fiscal year, right? Okay, so here we are. We're good to go. That's our balance sheet at the beginning of the year. Makes sense, right? We have debt, we have assets. Our debt is larger than our assets by $2,698.95. Therefore, we have negative equity from standpoint of tax basis. But again, balance sheet at this point is not important to us because we dealt with our assets. What's important is the profit and loss statement. So profit and loss statement is essentially tells us how much taxes we will be paying. And at this point, again, we entered all the depreciation expense that our accountant would suggest that we take, and in this case it would be section 179, right? We would expense the entire cost of the asset, and we would have to pay taxes on $69,691.53. Of course, there would be other implications depending on how the taxpayer is filing, and there'll be other nuances. But as far as Schedule C goes, all of this information, right, the sales will be entered in Part 1, and then expenses will be entered in Part 2, and we would end up essentially with a net profit, and in this case, line 31 will equate to net income right here, right? And that's what would transfer, right, to our Form 1040. So information, if you send your accountant this profit and loss statement, they'll file your taxes and they'll be happy as they can be because everything they need is right here. It's been booked. All they have to do is essentially take information from here and enter it into corresponding fields, which at this point is extremely easy, right? So supplies, you would add these amounts and enter them into supplies category, right? Right here. Line 22, repairs and maintenance, you have one right here, you would enter it correspondingly, and so on and so forth. Advertising, right, you have one of those, and then whatever is not essentially fitting here, there's a separate schedule for other expenses, right, so they can be added and entered into line 27A. That's it, right? You just booked an entire year of food truck operations. You prepared all the information you need to file taxes. And once they're entered into Schedule C, you're good to go.